Good morning. It's Monday, June 17th, about 6 a.m. Central Time. All right, the precious metals are weaker after Friday's snapback rally. If you trade U.S. equities, you're going to want to roll from June to September today. Now, the equity markets have drifted lower to sideways after European stocks have begun to slide. We've seen France's CAC 40 erased all of its gains for 2024 after analysts downgraded the region following calls for a snap election. It's essential to watch global equities beyond U.S. equities, where a secular bear market could be about several weeks away. We'll want to wait for a technical confirmation before attacking the bear side on the U.S. equities. I mention all this because I know many of you trade mining stocks. You're going to want to pay special attention to a bear market developing in the U.S. stock market. Why? Remember that miners are just companies and that over time they tend to correct the same way that U.S. equity markets do. Traders seeking safety from a correction will oftentimes rotate out of those miners and into safe haven assets such as gold bullion rather than the miners themselves. So something else I want to bring up to you is the process that I use to identify reports that come out the week ahead and how I interpret them by looking at what happened in the previous month. So this week we've got a whole flurry of data coming out. We've got Monday, we've got Empire State Manufacturing Index today. We got Tuesday, we have retail sales and industrial production. Last month we saw a massive miss in the retail sales number, and gold futures rallied about $28 on that news. Now Wednesday, we'll have UK CPI and core CPI. They're expecting that number to cool. And then Thursday, we have initial claims expecting 240,000. That was a big uptick. Those are going to be the two numbers that I primarily watch beyond that retail sales number. Friday, we'll have the flash services PMI, which is also expected to cool. Now, again, the reason why I bring this up, and this is what you guys can do as well, is you bring up the list of what economic data comes out next week. You highlight the ones that are going to most likely impact the precious metals markets or whatever market that you look at. And then you rewind to the previous month, you align the chart data up with that particular date. So if you go and you look 1 month ago and you look at Wednesday, May 22nd, UK inflation data surprised with a much higher than expected reading. It led the market to believe that the US inflation data would follow suit and be much higher, because oftentimes the same way that the Bank of England reacts, the U.S. Federal Reserve reacts. Oftentimes we mirror each other in what our economic data is and then also our policy direction. So this caused a anticipation of a breakout here in the 2-year yield. The result was, this is on May 22nd, gold was down $42. You take the next day, which was Thursday, May 23rd, they had the flash manufacturing PMI. They were expecting 50. The actual came out at 50.9. The flash services, they were expecting 51.2. The actual number was 54.8. This is US data. This is data that's going to come out this week. A number above 50 indicates an expansion in an economy. The result was gold was down $51. So what I'm telling you here is that if we get out of the woodwork Monday, Tuesday, Wednesday on the gold market, just pay attention here that you have some things coming out that could send this gold market in a massive direction spin one way or the other. So looking at the trends now in the gold market, gold does remain in a bearish trend as long as it remains below 2402. The market needs to correct that June 7th sell-off. So we saw that big breakdown there where on my proprietary trend discovery system, it's shifted from a neutral trend to a bearish trend. Your 2300 is going to be your critical level of support. And I may recommend to our clients to purchase the 2300, 2250 put spread as protection against their longs. The stochastics still remain in oversold territory. DMI Plus could cross over DMI Plus, and the average true range right now on the gold market is $38. Often in the last week or so, we've seen these types of moves where it moves about $31 to $38 a day. Now looking at the silver market, the price has moved to a neutral trend because of the fact that on June 13th, we did close below 29.14. However, it has recaptured the 50-day moving average and is tend to hugging either side of it right now. The stochastics have declined into oversold territory, and the average true range is about $1.09. So on the silver market, the two critical levels that I'm going to watch are $31.20 on the upside and $28.26 on the downside. A close above that 31.20, that will attract new money, new bullish momentum. The phone will ring off the hook, and every clown will want to buy silver again. Whereas when you get below 28.26, it's going to open up another wave of selling, and no one will call to want to buy silver whatsoever. They will panic and they will head back to their caves. So it's hilarious how the way that the mentality of the trader is. So it cracks me up. But anyways, that's going off on a tangent here. So we're going to continue to want to watch the dollar index. We'll want to watch U.S. equities if they start to break. If they start to break and they go bearish trend and you trade the miners, you might want to consider some protection through put options and things like that on your particular position, sell covered calls. Not a formal recommendation, just a process that I would look at. If I was holding a legacy position, say something like Apple, and then all of a sudden we break to a bearish trend on the NASDAQ, of course, I'm going to look at trying to protect that position while maintaining some upside momentum. So other than that, you guys got any questions, give me a call. Wednesday, we do have a holiday here, but I will still be working at the desk. So if you need something, give me a call. 312-858-7303. Remember, futures and option trading does involve risk of loss. May not be suitable to all investors. Good luck, good trading.